I had an interesting talk about the 6 key lessons I've learned as a fee-for-service financial planner with Ellen Roseman's investment club recently. It's the club is sometimes called Ellen's Degenerates. I felt actually quite honored to be asked by Ellen. They've had investment guest speakers before, but never someone just talking about financial planning. So my views are common sense based on experience writing over 1,000 financial plans and making them work for the lives of our clients. However, they are unconventional compared to the investment industry's normal practices. So, Ellen Roseman, in case you don't know, is a journalist who sticks up for the ordinary Canadians. Her personal finance and consumer columns appeared in the Toronto Star for 20 years. She was the Star's business editor, a columnist for the Globe and Mail, associate managing editor of the Globe's Report on Business, author of 4 books, has a podcast now, and she's been teaching courses in investing and personal finance at the University of Toronto. This video is the actual Zoom recording of the club meeting with the other members removed for confidentiality.
Just wanted to mention that if you go to Ed's site, it's packed with information and articles and talks and all that kind of stuff, but it also has information about his fee-for-service advice. There's a much smaller group of financial planners in Canada that charge only for their time or their effort in making the financial plan for you. They don't get any commissions for referrals or for selling you investments. And on his site, if you look up fee for service advice, he has the amounts, the dollar amounts, which is great. It's not just click, 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 and all of a sudden you realize later that you've agreed to pay so much. So he has $6,000 plus HST, that's suitable for most people. Comprehensive written financial plan with our interactive process. And then 3,500 if you become a full service client, which means that you can keep updating your plan or keep checking in with you to see if you're on track.
Yeah, it's and also there's a optimal retirement for people just creating a retirement plan who are retiring. We charge it's 5,000 for that, and then so we give a 2,500 refund for people to become full service. So full service is where we work with you over the years to create your plan. So there we only take on clients if we're looking after all of your finances. So all of your investments, we want to have it managed by one of our portfolio managers. I guess with most of you people probably wouldn't be something you want to do, but we find one of these elite portfolio managers to manage it all. And we just find if we see everything, we can just give you far better advice. And then we monitor your plan over the years. We're there to deal with all your issues, and we often do your personal taxes as part of the process.
Absolutely.
And so it's an all-consuming, and we're kind of your financial gurus for everything. When you're retired, we get into estate planning, a lot of things like that as well. So that way you're not alone when you're doing your planning. So as a financial planner, I've done well over 1,000 financial plans, and I get a different view that for the investment industry, which I call unconventional wisdom. And I think some people think think of what I do as kind of odd, but to me, it's as a financial planner and an accountant, I think it's just normal. So let me give you a few things that I've found that really work. These are things that I find really work in a plan. So what I found is hardly anybody can actually retire comfortably with balanced funds. The investment industry, you go in to see anybody, they give you a risk tolerance questionnaire, you're moderate, you're in a balanced portfolio, a 60-40 or something portfolio. And I try to make financial plans work. So if you're a 60-40, what's your long-term return conservatively going to be? Maybe 5% or something like that. And you try to make a financial plan work with that. And I find it's a ridiculous amount of money. Like younger people who are saving up have to save up like between 35 and 50% of their gross income just to retire at a reasonably comfortable place. And that's when you're retired. Now, I think, or when you're saving up. So, and now I think a lot of you are retired. I find it's a similar issue after you retire. So a good rule of thumb for being retired is the 4% rule. It's not perfect, but it gives you a good guideline of where you are. So if you take 4% of your investments out every year and then just raise that by inflation, I actually went through the last 150 years to see, is that actually a reliable strategy? Can it give you at least 30 years? And the result is kind of surprising because it worked, 97% of the time if you're almost all equities. If you're between 70 and 100% equities, it worked 97% of the time. But people with a balanced portfolio, or a lot of seniors do the age rule, right? So your age, the bonds you have. So they end up with a lot more bonds, and then it actually failed most of the time. So it's this whole, when you're trying to make a 30-year retirement, so having the more equities you have, the more reliable your 30-year retirement is. And I think a lot of people think, oh, bonds make it safer, but they don't. And the reason is bonds have long periods of time where they just get killed by inflation. And that's, where that can happen. And the returns are lower. So, for example, for people who have all bonds, all GICs, I tell them 4% rule won't work for you. You got to have about 2.5% is about all you can take out of your portfolio. But taking 4% out if you're very high in equities has worked 97% of the time. And if you manage it somewhere, so when investments go down, you take a bit less, you can make it 100% reliable. So, and that also makes your retirement way more comfortable. If you can take, if you invest more effectively, you get more growth. A surprising stat I think most people will find surprising, because I see all these financial plans. So let's say you retire at 65 and you live to 95 or 100 or whatever it is. And let's say you plan so that you run out of money kind of when you die, and you let your software calculate that. What you find is the retirement income you get, close to 80% of it is growth after you retire. So, you retire with $1 million, but over 30 or 40 years, you actually spend, 6-8 times that amount of money is what you actually spend, because your investment, it's 30 years that you're growing ahead of you. So it's the growth after retirement that actually gives you most of your income. It's not the principal that you have, on the day that you retire. So that's why I always talk about having a growth mindset. Always, being optimistic for the future, have an equity focused portfolio, and be confident in the long term. And that's, I find very much the secret to retiring more comfortably and getting better investment returns is all part of it. It's not only higher returns, you want to have reliably higher returns. You want to be, what I always talk about, I would define risk differently. The investment industry defines risk as, well, what if investments go down? But I don't worry about that too much, because if you study the stock market over history, it goes down, but it has always rebounded, and usually most of the time within 1 or 2 years. 88% of all declines are recovered in 1 or 2 years. What I look at is, how confident am I that 20 or 25 or 30 years from now, I'm going to get a really good gain over the long term? So what do I have to do to have an investment process, a method that I'm confident in long term? And that's how we define risk. So, and for the most part, the major equity markets like the MSCI World Index, the S&P 500, you study them over 25-year periods. They've been quite reliable.
I don't have a whole lot of bonds in my portfolio, but I was reading in a number of places where they said if you are getting a defined benefit pension, like a bond almost, because it will continue to come and it's often inflation protected, or there's some anti-inflation in it. You get the CPP, the OAS, you have maybe your mortgage-free house. So a lot of that is stability in your life that can replace some of the bonds that you might have thought you needed to have.
Yes, I agree. You can think of that as the bond portion, because it's kind of a fixed portion. And if the stock market does really well, you don't actually get any more of those pensions, right? You don't get any more of it, or any less if it does badly.
Right.
I know the actual pension is invested in stocks and bonds, but as far as what you experience, it's essentially like a bond. Yeah, so I agree with that. Then you could be more confident. I find people that have a good pension are often more confident in having other amounts in their equities, because if it doesn't work, well, still be all right. But from planning, I find even people with no pensions at all, you can be very confident. You can be confident in a good equity, a well-structured equity portfolio long term.
Yeah. What would be the minimum that you'd like to see someone without, say, a corporate pension holding in bonds, or a house that they can turn into some kind of income later on?
Most of the clients that we have are 100% equities. Even the retired clients are 100% equities. Not all of them, but most of them. And you can learn to become comfortable with it. And I'll give you an example. So the S&P 500, kind of in the modern stock markets, if you go back in the 1800s, it was mostly farming stocks and that. But from around 1930 or so, when they got into automobiles and consumer products, that was kind of the modern stock market. And from then till now, the worst calendar year, if you take 25-year periods of the S&P 500, the worst one was a gain of 8% a year. So it's had all these ups and downs in between. And yet if you're in for 8 years, it's basically always giving you 8% or more, you know? So you can rely on these things as a long-term investment if you do them well. So then you don't need bonds, because bonds actually, I think people think of them as safe, but they can be really risky. So from 1940 to 1980, Government of Canada bonds after inflation were down 50%. 40 years later, you were down 50%.
Wow.
If you had enough money to buy 2 cars in 1940, I put it in government bonds for 40 years. At the end of that time, I could only buy 1 car. Like they were just, from 1940 to 1980, they were just a horrible, horrible investment. And then from 1980 till 2020, yes, because interest rates were going up and inflation was high, And then 80 to 2020, interest rates were coming down. So we had 40 years where bonds had ridiculously high returns for bonds. And so the returns you saw between 1982 and 2020 in bonds, don't ever expect to see them again, because almost every year interest rates came down, which makes the bond returns higher. So I don't think bonds are safe, because bonds can literally have a 40-year period where you lose money. And that's never happened with stocks. Stocks, you've always done well, if you're in for a long period of time.
I ask a quick question there. I know how you feel about dividends, I think, but the 4%, could part of that not be dividend income?
So the short answer is yes. So dividends, I think people think of them as, I have a video out called Dividend Investing is a Brain Fart. And I think people think dividends are actually new money, but it's not. A dividend is a withdrawal from your investments. That's all it is. It's a withdrawal from your investments that the company does instead of you. So, you see on the ex-dividend day, if you get a dividend of $1,000 on the ex-dividend day, your portfolio goes down by $1,000 plus whatever happens that day. It's taxed slightly differently, but basically it's exactly the same thing as if you sold $1,000 worth of shares. So that's why. So if you're doing 4% rule, you can just take 4% out of your 4% withdrawal from your investment. And if you're getting 2% in dividends, well, okay, that's fine. That's 2% of it. And the rest of it you can do by withdrawing, by just selling some investments a little bit.
Right.
So,
also, there's so many people, we were talking about this, I think, that write dividend blogs in Canada and dividend articles and books about how their strategy is to save for retirement with enough dividends that they could live on. And I don't think they realize how hard it is to get to that point where it can support, say, a family, because, you have to have very large amounts of capital to create all these dividends.
yes. So, if you say, well, you can live on 4% of your investments, most stocks pay dividends. However, the average dividend is what, is 2%, a little over 2, right? So you need way more if you're just going to live off dividends, you need way more money than if you were just going to sell a bit of your investments all the time. So what I find dividend investors always do, they get kind of sucked into buying stocks that pay higher dividends, which are often, lower long-term rate of return. So to me I want the stock that has the highest long-term total return after tax. That's the one I want. And whether or not it pays a dividend, to me, that's just a small detail. So for example, what we do with most of our clients is we any dividends, we just automatically reinvest them, don't even look at them. So I can say for my own portfolio, I'm unaware of what the dividends are. To me, it's not a number that I care to know. You just automatically invest them all. Don't even look at them. And then, when I retire, for our retired clients, we decide how much we can take out. And it might be more or less, depending on what their situation is, but we're taking a regular amount of investments. I have a video or a blog, a post called Self-Made Dividends. So self-made dividends are where you just sell a bit of your investment each month. So you got $1 million. Instead of taking a 4% dividend, I'm going to have no dividend, and I'm just going to take 4% of the year divided by 12, first of every month. I'm just going to sell, that's 3,333. I'll just sell that much of my portfolio every month. So that way you get a constant income. It's nice for retirement. You get kind of a regular income every year. You just raise it by inflation. And when I compare that to actually living off dividends, it's better in every possible way. You pay less tax, it's more reliable, you control it, it's the same number every month. I made a list of pros and cons, and basically there were 10 advantages for self-made dividends and nothing for ordinary dividends. So I find it's just a so much easier way to work.
Yeah, I think a lot of people have I always did it, but preferential tax rates in Canada for dividend income.
Yes, but if you have self-made dividends, like where you're selling a little bit, you're actually paying even less tax. Because what happens is, like, so yeah, you have $1 billion in portfolio, you sell your 40,000 a year, whatever it is, but really you're only paying tax on the capital gain, on the capital gain portion of it, right? So let's say that your investments have doubled up to that point, then you sell 40,000, only 20,000 of it is capital gain, and only 50% of capital gains are taxable. So you only put 10,000 on your tax return, right? So with self-made dividends, I get 40,000 of cash, but there's only 10,000 on my tax return. However, if it's Canadian dividends, I get 40,000 and it's grossed up by 38%, right? So now I have like 60,000 on my tax return with dividends, but only 10,000 with self-made dividends. And I can show you the actual tax rates. Okay, this is taxes before and after retirement, right? So this column here is what the actual tax rates are. So those are your taxable income, the brackets, and here's what the actual just income tax are. However, retirees also have the guaranteed income supplement, which is clawed back on lower incomes, and then they get the age credit, which is clawed back, and then the old age security is clawed back. So if we add all of them in, this is what the tax brackets look like, right? So the really high tax, the highest tax Canadians are seniors making less than 30,000 a year. They're paying 50% and even 70% tax is what they're paying. And the worst thing actually is if it's a dividend, because if you're lower income. So, a lot of dividend people say, oh, well, you know what? I can make, 60,000 or 65,000 with no tax, right? If it's all Canadian dividends. Well, that's only true if you're single and under 65, under age 65. Because if you're married, your income is grossed up and that comes off, your spouse could claim as a deduction. And if you're retired with no other income, you get this guaranteed income supplement, but it's clawed back on 50% of a taxable income, which means 70% of dividends. So if you get a dividend of $10,000 and that's all you have in income when you're retired, you're going to lose 7,000 of your GIS because you got a $10,000 dividend. It's crazy. So here is when I take these same brackets, okay, and I put them by type of income. So this is, again, these are people over age 65. Here's the tax brackets. So, and here's the same. So if it's all interest, then it's the same as this column, right? It's the total income. So that's the tax bracket. Here's what it is with dividends, which is weird because it's 62% tax if your income is 30,000 or less per person. Then it goes into a negative tax. We actually paid negative tax between 30 and 51,000, and then it's up to 9. And then when you get to higher incomes, it's 30 and 40%. So that's what you pay on Canadian dividends. This is what it is on capital gains. And this is what it is on self-made dividends. So self-made dividends, let's assume that your investments have gone up, 50% since you bought them. So the book value is half of what they're worth today. So then the self-made dividend tax is just half of whatever the capital gain is. But notice it's always low. It doesn't matter if you're high income or low. It doesn't matter if you make 2,000 or 2 million. You always pay very low tax on self-made dividends. But Canadian dividends, you have this super high tax, and then you have negative tax, then a little bit of moderate, and then really high, and then high tax again. So it really depends on what your taxable income is. So I find with dividend plan tax, you got to kind of really plan what your taxable income is going to be, so that you want to try to fit in this area here, so that you don't get into the high clawbacks. So what I find when you look at it this way, the tax this way, you end up making decisions very differently. You're trying to plan it around. People that are working, their salary is the income that they get in cash, and it's all taxable. And they're used to thinking taxable income is your cash income. But when you're retired, your cash income and taxable income can be completely different, right? So if you take money out of TFSA, it's cash, but there's no tax. If you take it out of your non-resident investment, it's cash, but there's probably better capital gains, but it's low tax, right? If RRSP, it's fully taxed, and so depending on where you take your investment out, it's very different. You can plan where to take it from, and then how much to take. You can plan to be in the low tax brackets. So
some people are arguing, well, not arguing, but putting money into high interest savings accounts and that kind of thing, paying, 5%. But that shows up as fully taxable as interest, right?
It's fully taxable, yeah.
At the
As it-
highest marginal tax rate.
Yeah.
yes, any other kind of investment income is generally lower.
Ed, do you have a problem if people have a TFSA that's mostly invested in dividend stocks so they can take it out without any tax?
Yeah, well, see, if it's in a TFSA, whether or not you get dividends is completely irrelevant. It doesn't matter. Basically, what you should be trying to do is just buy the best stocks that have the highest total return. So I'm only looking at total return.
Right.
Right. So, and to me, it's very clear in a TFSA. It doesn't matter if you get a dividend. There's no tax consequence if there is or there isn't. But I think people tend to think that, oh, I can get a dividend forever because the company, because they think it's free money. And if I sell shares, oh, I'm going to eventually run out of shares. But it's not true, because either one of them is a withdrawal from your investment. So you can sell shares forever, just like you can collect dividends from forever. If you have the same company, honestly, if I had a company that paid me a dividend, and if I could buy exactly the same common shares of that company without the dividend, I would always prefer that, because then you just get what I want. If I want a dividend, I would just sell that much of the investment. I can create any dividend I want. And I actually get a big laugh out of all these dividend people, because I see a lot of the dividend bloggers, and a lot of them are young, right? They're like 45 and they're saving up and they're getting all these dividends. I'm thinking, well, you guys are working, and this is taxable income on top of your job. Like, why do you don't need all this taxable income, right? Wouldn't you rather just delay it all and then much later have no tax on it until after you retire? Wouldn't that be way better? So with self-paid dividends, basically you set your dividend to 0 while you're saving for retirement. And then the day you retire, you set it at 4% or whatever you want. And you're collecting that amount, and it's a regular monthly amount. So it's just so much easier to plan your life when you're getting regular income.
Do you have any use for dividend reinvestment programs, or just reinvesting your dividends?
Yeah, like we do it automatically. Whatever dividends we get, we just automatically reinvest them. So if the company will do it, then that's fine. That's it's one less step for us or for our portfolio manager to do, but that's fine. Yeah. But often those are the higher dividend paying stocks, the more conservative stocks that might have a lower long-term rate of return.
Right.
But if it's a good company, and if it has a dividend reinvestment plan, that's fine. Then then you're reinvesting in the same company, assuming you want to keep investing in that. But yeah, so dividends is something I've just found it's by looking at the way I do or the way I see it from a tax perspective, it's just a really different investment. So by the way, just wanted to show you the one other thing. This is the same kind of thing for parents. So believe it or not, I just did a video with a podcaster who's in his 40s and retired. This is part of this FIRE movement, retired early. And yet, so he's retired, but he's got 2 kids in the home. So he's getting this Canada Child benefit, and it's clawed back. And if you get 2 or 3 kids, the clawback is almost as high as the income tax, and it changes everything. So in their case, this is the income tax. The rates are in their 20s until you make 55,000. So this guy's got 2 kids. If you got 2 kids, you have a 20% tax plus a 14% clawback. So the higher tax brackets start way low, like 17,000 per person. You're already in a 34% tax bracket, like 20% tax plus the clawback of your child care benefit. So it's a similar fact. Like seniors have other tax issues with the. Seniors have the GIS and OAS clawback, and the younger people, parents, have the child care benefit. So now some people think clawbacks aren't income tax, but to me, I just look at it. To me, they're not actually tax, but they're exactly the same thing as tax, right? It's money that goes from you to the government based on your taxable income. So it like walks like a duck and quacks like a duck.
So we have a question from
from
Marlene, who says she wants you to clarify the difference between capital gains and self-made dividends. When you sell your stock, there's capital gains. So how do you figure out what the self-made dividend is?
Right. Okay. So self-made dividend, all it just means is you sell a bit of your investment every month and you create your own dividend, basically, right, by selling a bit. Now, if you sell a bit of your shares, you're going to trigger a capital gain, assuming it's gone up since you bought it. And it depends on how much it's gone up since you bought it, what your capital gain is. So the capital gain that I showed in that chart was that's the tax on the portion that is a capital gain. And then, so a self-made dividend, so if your investment portfolio has doubled since you bought it, then when you sell it, the cap, half of what you sell is your original your original money, and half is the gain. And then, if it's doubled, then whatever, then half of it is the gain because your money is doubled. And then half the capital gain is taxable capital gain. Only a quarter of what you get is actually taxable income that shows up on your tax return. So that's how I showed. I don't. Does that make it clear the difference between self-paid dividends and capital gains? Self-paid dividends is just the capital gain you get from selling it out of your investment each month.
Okay. Chris, do you want to just repeat your question that you have on the chat?
Yeah, sure, if you don't mind. Ed, I've been reading a lot about just different strategies of drawing down an RSP early before the mandatory age of 71, and maybe turning part of it into a RIF and trying to, if you have a larger RSP, then you want to minimize your taxes sooner. I think it's a strategy. Do you have any comments on that?
Yeah, like we actually look at that a lot on for our clients. Whether that works depends. The answer is it depends on a whole lot of things. So when we're designing a retirement income, there are actually is this actually one of my topics? Is retirement income?
That's okay.
Yeah, when we're designing our retirement income, there's two overriding tax philosophies. Okay, one of them is defer tax as long as possible. And it's always better to pay tax later. The other one is let's trigger some tax, but always try to stay in the low tax bracket. Okay. Now, which one is better depends on if we look at the situation where you are. So let's say you're going to defer forever. That means you're going to sell, you're going to cash in all your non-registered investments and your TFSA early and try to defer your RSP as long as possible, that take the absolute minimum. So you're deferring your tax as much as possible, and you're going to sell everything that's got low tax. Okay, and that way you pay tax much later. So that works for a fair number of people, but probably less than half of people does that work. The problem is that then later on, you're only left with your RSPs and pensions and everything's taxable, and you can get pushed into a higher tax bracket later on. And that's when what you were saying might be beneficial. If you're going to get pushed into a higher tax bracket later, I'd rather pay some 20% tax than pay 40% tax 10 years from now. So then what we do is we get into the math. Well, how much higher of a tax bracket will you get pushed into, and how many years until you get pushed into that higher bracket? And then we can kind of figure out, so the tax that you don't pay is money that stays in your investments can grow. So if that stays there and grows, is that going to cover the tax that's there? So incidentally, I think people sometimes do the same thing with your estate, because you might be in a fairly low tax bracket as a senior, but then when you die, your estate is taxed at 54%, right? The very highest rate. It's because everything is deemed sold, right? Your properties are sold, anything out of the home is taxable. All the RSPs and RIFs are deemed cashed in. So there's a fair number of people that have fairly low income for much of their retirement, but then they show $1 million or more in their taxable income on their estate, and they pay 54% tax on it. Yeah. So they think, well, maybe I should sell a lot of that RIF earlier to avoid the 54% tax. But then you got to look at, well, how many years earlier? And if you have equity focused portfolio, you don't want to sell more than say 15 years earlier. So because if I pay 20% tax today that I could have avoided to save 54% 15 years from now, well, that extra tax could have grown to that much in that many years. So usually I tell people, don't worry about the estate tax until you're like within 15 years of death, kind of thing. Until you're, 80 or something, don't worry about the estate tax. Just, plan your other income. So, but yeah, that's an excellent question. It's how you plan the tax through retirement it's a huge factor.
Yeah. I had a couple of questions about the dividends. Mike Haru, who's Dividend Stocks Rock, he's one of the big bloggers in Canada. I think he's like you, he's all over the social media. And he came out pretty fast after your dividend article with his defense of the strategy. And I don't have it in front of me, but did you think he made any good arguments?
Oh, you know what? I haven't seen it. I should look that up.
Okay. You can find it on his site.
I haven't seen it. I'll have to look it up.
He agreed with most of it.
Pardon me?
He agreed with most of what you had to say, actually.
Oh, really? Interesting. Yeah, like I think the only advantage of dividend investing I can see is that it can be a way to help you pick decent stocks. Because if they pay a dividend, most likely they're not losing money or about to go bankrupt or something. Like, so you don't get the big growth stocks, right? You don't get Warren Buffett's company, but you generally aren't getting, companies about to go bankrupt and stuff. So you can use it as a way as a broad filter to get decent stocks. So,
Yeah.
one of the big drags for me is, I think there's a question here about asset allocation or geographic allocation.
Yes.
Yeah.
Geographic diversification, Canada, US, other developed countries, emerging markets. What are your suggested allocation?
Yeah, we don't specifically pick regions that way. But we try to invest globally all over the world. US is, believe it or not, about 70% of the world. So if you invest just in the US, that's pretty good. It's pretty good, and it's done better. Canada has done quite a bit worse than the world, right? So we generally have pretty well nothing in Canada. Invest basically all over the world or in the US, and have Canada maybe has a handful of good stocks, but I know for our portfolio manager, there's almost nothing in Canada, maybe 1 or 2%. In Canada. So, and the returns are a lot bit lower. And like Canada's stock market to me it's not even a core holding. It's not even a diversified portfolio. Like it's basically a resource and financial sector fund. But outside of those two sectors, there's hardly anything, right? We don't really have any. The one I laugh about is our healthcare industry, right? Which is mostly pot stocks. It's not a health, a TSX healthcare ETF is not what it sounds like.
Yeah, the first ETF that came out with cannabis stocks from Horizons,
Yeah.
the Korean owner wouldn't let them put cannabis in the name. So they had to find a euphemism. So they used the healthcare thing instead.
Yeah, healthcare is a pretty loose definition.
Can you satisfy my curiosity? What is a brain fart? And where did that come from?
Well, I don't know, like a fart, you're just excreting gas that doesn't do anything. And it's a thought that, doesn't do anything. It's, because dividends sound good, but when you do the math, there's no advantage of dividends at all. Absolutely nothing, other than maybe helps you pick some stocks. So, and it may lead you to pick worse stocks. Like it may lead you to buy more in Canada than makes sense. And it may lead you to buy stocks that pay high dividends but don't have high returns.
Yeah.
There's
another reason that I think helps people, especially if they're nervous. If they're watching the up and down vacillation of the stock, they can get really upset and they'll watch it daily, where dividends, they only change every month or every quarter. And if they're just counting up their dividend income every month, if say they own 12 or 15 dividend stocks and they're just looking at how quickly their income grows, they'll probably be a lot more patient and have a longer term view.
Yes. Yeah, actually that is a good point. So this is actually one of the things that I found. So you go to any advisor, they always give you a risk tolerance questionnaire, right? Like, so what I found is thinking is that your risk tolerance is part of who you are, but I found it's not. Risk tolerance is a learned skill. You can learn, like the stock market goes up and down, but if you study it, you can learn, what? It's actually pretty reliable as a long-term investment if you have, a good portfolio. And so you study, so we've studied a lot of S&P 500 because we've got the longest track record of it. But you see so we do that with clients. We just show them this is what the stock market does. So it goes down, I don't know, every 4 years it'll fall probably 20%, and then it falls maybe 30% or so, or 30, a little bit more than 30%. I don't know, once or twice a decade or something like that, and then 40% maybe once every 3 or 4 decades. But it pretty well always comes back for a while. And over the long term, it's quite reliable. And you show people this is what it's like, right? Because I think people tend to think it's gonna go to zero, but stock market has never gone to zero. It's like individual companies, of course, do. But if you're invested effectively long term, you can see how it goes, and you can learn to have a higher risk tolerance. And it's a highly valuable skill, because if you just fill out the questionnaire, like a lot of people, I think they're low risk because they don't have much knowledge about the stock market. So they're scared of it, and they think they hear, oh, it goes down and you could lose money. and then they want to be very cautious. But once you get educated about it and you learn that it's fine long term. In fact, if you easy way to beat the market is whenever it goes down, you just buy more. You're gonna beat the S. You want to beat the S&P 500? Guaranteed way is you just hold the S&P 500 anytime it falls by 20%. You buy extra. That's it, and you're going to outperform it. Once you get this confidence and know how to deal with the ups and downs, then you can invest much more effectively. So now you're right, Ellen. If instead of like if people are scared to sell stocks, and if your stocks don't pay a dividend, you're selling a bit, and it goes down, and oh my God, that looks scary. So and meanwhile, if you're just getting dividends, you don't even if you're getting dividends, you don't have to look at your shares, right? So, but I find even with self-made dividends, you can automate them. So your portfolio manager just automatically sends them out. So you automatically get money every month. So we have some clients that when the market goes down, they just stop looking. One woman actually emailed me. She said, "Just tell me when it's safe to look at my portfolio again." Because I'm not even going to look until for now, because it's the human gut, right?
Yeah, there's research that shows that people who don't pay much attention to the stock market do better because they're not thinking about it. They're not preoccupied or scared or
right.
staying at night.
I think the optimum and one study I saw is 2 years. If you look at your portfolio less often than once every 2 years, then you have worse returns. Or that was the optimum. People who only looked once every 2 years have the highest return. People who look more often or less often do worse. You think, well, my God, 2 years is way too long. But the problem is that if you have a human gut, your gut is not made for investing. It's like we learned, fight or flight, right? So the market goes up and everybody wants to pile in only because it's going up, and then it's going down. Everybody wants to get out. You've probably heard you should sell high and buy low, but the vast majority of investors, 80 or 90% of investors, do the opposite. It's which day there were more stocks sold than any other day. It was March 9th, 2009, like at the bottom of the big crash in 2008. At the very bottom, the market's fallen over 40%. And that's when people are selling more than ever. And institutional investors are just as bad. They're dumping their stocks at the bottom. It's like you bought the toilet paper when prices were high at normal prices, and then you return it to get a refund when prices are really low, and they're only going to give you the refund really low. That's crazy too. But yeah, so risk tolerance is a learned skill, and it's a highly valuable skill if you can to learn to invest more effectively. If you can learn to be higher equities instead of having a balanced portfolio over 30 years, that one skill can be worth millions of dollars to you.
And that's kind of a segue into your talk about the Smith maneuver, which many people may not recognize, and I'll let you explain it. But it's a way of using your mortgage payments to be advanced and then to put them into investments. It's a leveraged way of investing, and leverage, usually borrowing to invest, entails more risk because people get more nervous when they're paying interest on losing investments.
Yes. So the Smith maneuver, it's kind of a quirky name, but basically you're just borrowing from your home equity to invest. And it's kind of a method while you have a mortgage that as you pay your mortgage down, you automatically reborrow the amount, so your total debt stays the same. And you slowly convert your regular mortgage into a tax-deductible credit line. And so you're building up investments. And what happens is you're building up investments that don't come out of your cash flow, because you keep borrowing it, and you can actually borrow to pay the interest on it as well. So it's kind of a neat strategy that works well for a lot of people, but it is borrowing to invest, which is not for everybody. Right now, borrowing to invest is, I think, both the single best and the single worst idea of investing. So basically, all the wealthy investors, all the wealthy people in the world borrow to invest. So so if you can borrow at modest rates and it's tax deductible, you can invest and get a higher rate of return and over the long term, it's just a hugely successful way to invest. But a lot of people, they panic and sell when it's down, and it's worse if it's borrowed money. I borrow some money, it goes down. Oh my God, I panic, I sell. Now you're not going to get it back, right? So we do a fair amount with Smith maneuver and some other kind of leverage strategies when you're borrowing to invest. It's effective for the tax deduction, and it's an effective way to grow wealth. but we tell people like if you're going to do it, you need to commit to at least 20 years. It needs to be a long-term thing because we don't want to do it unless it's going to have a very high chance of success. If you're in the stock market for 20 years or more, you're almost for sure way up, and it's almost for sure done really well for you. But I've had people say, well, let me try it for a year and see how it goes. I thought, well, don't even start with that idea, because I have no idea where the stock market's going to be in a year from now. I do know that, based on history, 25 years from now, the stock market will be between 7 and 17 times higher than today. So it's basically always been at least 7 times higher 25 years later. So if you're in a long time, it's going to be way up. But 1 year, I don't know, who knows what it's going to be. And if don't borrow to invest for 1 year, because a quarter of the time you would lose money, and actually more because you have to pay your interest, right? So anyway, but the Smith maneuver is a really good way. So what I find with a lot of seniors, have a home. You see a lot in Toronto. They have a home worth $2 million that's paid off, but they have hardly any investments, and the investments they have are conservative, and they get the 2 government pensions. And here they're multimillionaires, but they're living on $20,000 a year before tax. And I've actually had a blog post about that. I call it millionaires in poverty. Like, why does it make sense that you're worth $2 million and you're living on $20,000 a year? How does that make any sense? But all the options sound bad to them, right? So you could sell your house and rent, and then you got $2 million to invest, and I'll pay your rent and way more. But no, I want to stay in the house, and they don't want to borrow against the house to invest. They don't want to. That's too risky. They don't want to borrow against this house to spend, because that sounds dumb. And so they live as multimillionaires with hardly any money. So that to me is where, like a strategy like the Smith maneuver, you're using a portion of the equity, whatever part makes sense. You're getting some investments out of it. Now you can get that to pay for itself and send you some income against it. I don't know, just an effective way to try to use the equity.
And you say on your site that you have more people doing Smith maneuver than any other financial planners?
Well, over the years, we've advised we've helped a lot of people do it. So, and I guess I've kind of got known for it. So a lot of people just come to us just asking about it. Quite regularly, we get notes from somebody. I've read about Smith maneuver. I want to do it. And quite a few. They ask us questions. They go do it themselves. So, and we fair amount of us that they want us to write a financial plan that includes doing the Smith maneuver, and then they're going to work with us to implement it afterwards.
Okay. And it sounds risky, especially when you come to the end of your 25 years and you see that you haven't paid off a penny of your mortgage because it's all been recycled into your investments. But there actually was a guy called Fraser Smith, who worked in, I think it was Van City Credit Union in BC. And he was the one that originated it and got a lot of the clients of the credit union doing it. So they're more conservative, but they saw it as a good deal. And remember, Vancouver always had the highest personal real estate prices anywhere. And, it can make sense, but you have to be long-term and very patient.
Yeah, Fraser was actually in the late 80s and the 90s, he was doing it. And at that time, so right now we have like these readvanceable mortgages that all the major banks have. It's a mortgage linked with a credit line, so you can easily do it. So back then, that kind of thing didn't exist. So he managed to get a credit union to manufacture it for him and actually lend people, give them a new loan every month. It was kind of an unheard of process that he managed to get them a credit union to do for him.
And I remember some of the banks didn't come around for quite a while. They just didn't believe in it. But I think now most of them are allowing it. I think TD was one of the holdouts.
The only reasons we have them is because the trust companies had them.
Yeah.
So there were 2 trust companies, Canada Trust and National Trust, and they were taken over by TD and Scotiabank. And then when those 2 banks took them over, they had those mortgages, and then they became popular. So then BMO and RBC did it, and CIBC only did it a few years ago.
Oh yeah.
I have joked about it for years, saying all the banks do it except for one, CIBC. Maybe one day somebody from CIBC will be at my seminar and say, why is everybody doing it and you're not? But
okay. So Anne asks, what if there's a catastrophic world events? Is the stock market still reliable then?
The worst thing we ever had was the Great Depression. And actually, you know what? Like, catastrophic events may or may not affect the stock market. Like, like right now we've got some wars going on, but that doesn't affect the stock market here.
And I
Wars
think
used
after 9/11, there wasn't a huge impact on the stock market either.
no, like the stock market was closed for 2 weeks
Yeah.
and it opened up 15% lower, but it bounced back in a few weeks. Like it didn't, it came back very quickly, you know. And actually, COVID was actually a really interesting example because the market fell 35% in a month. In 4 weeks, it fell 35%. Really shocking. And yet, 6 weeks later, it had fully recovered. So, you know, if you were on a cruise for 3 months and came back, you didn't even know that anything happened. You know, well, except that I guess that's a bad example. Cruises got hit badly in COVID. But if you were just away on vacation somewhere, if you were backpacking for 3 months, you didn't even see that one. So yeah, the worst case was the Great Depression, and that was, you know, it was a world event. But more, I think back then the Fed in the U.S. and Bank of Canada were brand new, and they didn't even know how to run the economy, so they made it way worse. They didn't support the banks, and so there it took you know, a few years longer for the market to recover. But some people think even in Great Depression it took a long time to recover. If you think calendar years, January 1st, 1929 to 32. Right? So 4 years, the market fell 83%. And in the next 4 years, from 1933 to 36, the market had that was the biggest bull market in all of history. It went from if we went from 100 down to 17, the next 4 years, it went from 17 all the way back to 100. So the market more than quadrupled in 4 years. You know, so what you see with the market is the biggest gains and the biggest losses are right beside each other. The biggest day is beside the biggest up day, and biggest down day are right beside each other. The biggest up and down weeks, the biggest up and down months and years are always right beside each other.
I remember in COVID, there was, I think it was the manager of Omer's pension plan. And I caught this because I read the report the year after. I think, like a lot of people, they exited a lot of their positions so fast because it dropped so quickly. And then they didn't expect it to bounce back so quickly, so they couldn't get back in time and had a really big haircut that year. Like, yeah.
Exactly. People were panicking. Yes, they saw it going down. And at first you didn't really know this was something new. Like we didn't really know what this is going to do. And, you know, so,
yeah.
But I don't know, we just have this general concept that, you know, anytime the market goes down, for us, anytime the market falls by 20% or more, it's a buying opportunity. Just buy them. Don't worry about what's going on. Just always buy them. And so even in COVID, it fell 35%. We were calling clients, so that was a good time to invest, you know. And it was a lot of uncertainty then, but things do come back. You know, the stock market and the economy are really, everybody thinks they're related, but they're not. They're very different. Like you can have a recession and the market usually goes up during recessions. They're not really related. So when there's major events, often people panic and start selling their stocks. But you know why the stock market actually goes up? Like some people, it's a big mystery. Why does it keep going up? But if you take the profits of the companies in the stock market and track it, what you find is pretty well exactly the same over time as what the stock market goes up. So the reason it goes up is because all the underlying companies, their profits are going up that much. So when there's a major event, you have to stop and ask yourself, not just year to year, but over the next few years, how much are the profits of the companies in the stock market going to be down because of this event? You know, and don't just think short term, think longer term. And if you think, you know, so a lot of things that'll happen, you think, well, there's a war, but you know what? We're still going to be eating, and you know, most of the economy will still run. And so how much of the profits of the company is really going to be down? You know, I think to invest effectively, you need to have a confidence in the stock market. And if you don't have it, then you need to invest, you know, more conservatively with something else. But then you need to assume that your returns are going to be lower.
Yeah, we have a question about the Japanese stock market, which was stuck for 2 or 3 decades, and now it seems to be coming back a little. What do you think of that? That's a much longer period of limited growth.
Yeah, you know, interestingly, the Japanese market had, I think, the biggest bubble of all history. So, you know, back in the 1980s, right?
Yeah, there was a period where Japan's economic growth was surpassing the US.
Yes. So the US in the 80s, the Japanese stock market went from 200 to 40,000. So it had a 2,000% or a 20,000% gain. So you actually had 40,000 from 200 would be, say, 200 times the money. In 10 years, you had 200 times more. And then from there, it did nothing and kind of went down. Like 30 years later, it was down to half. But if you take if you take not just the 30 years, but you include the double, it still made, I don't know, it wasn't that much less than the broad stock market from 80 to to 2000. They were kind of weird that they had such a massive bubble. Like it was many times higher than, the tech bubble that we had in the 90s.
Yeah.
The Japanese bubble was something like 5 times the size of it. It was weird.
And a lot of it had to do with the management consultants saying that Japan had a much better kind of method of regulating companies and making employees enthusiastic. And the U.S., a lot of U.S. authors were writing books about how they could emulate Japan with the companies in the U.S.
Yeah, my wife and I actually both worked for manufacturing companies at the time. So we saw that they had, Kaizen and continuous improvement and Japanese manufacturing, and everyone is saying it's going to take over the world. But yeah, I mean that was a huge bubble. That there weren't nearly enough profits to support how much those stocks went up.
Right, which is always the limiting factor.
Yeah, it's worth looking at valuation of companies. Like fundamentals matter.
Okay. I can't remember if this was one of your topics, but I'm sure there'll be some interest in finding out, kind of common tax things that people could be using that they're not always using, either just before retirement or just after retirement, and especially in terms of moving taxes from spouses or giving money to your kids or, whatever, to take advantage of the tax system.
Yeah, I mean, there's all kinds of different tax strategies that you got to think of. Giving money to your kids is actually not usually not a good thing, because in fact, there's these new trust rules, right? If you do as much as just put your kid on like a lot of people put their kid on their house, their children on their houses, estate planning purposes only, right? But now that's because of the new trust rules. That's considered a trust, and you now have to file a T3 trust return every year. An accountant will charge you $500 or $1,000 every year to do that. And if you don't file it, there's a $2,500 per year penalty for not filing. It's a brand new. It's called a trust. Why do you think? Well, it's not a trust. I just put my kid's name on so that they get the house after I die, right? No, but they're saying no. It's in trust. It's in trust for the kid. It's they don't really own it. Putting it in anything joint with kids with the new trust rules is a problem. Like people have done it with investment accounts or with bank accounts. Sometimes it's risky if your kids have if they have a risk of divorce or they have a risk of going bankrupt or something like that. So for sure don't do it until your kids are old enough and their life is stable, and they're not going to get divorced, they're not going to go bankrupt, and so usually I think of that as something you might want to do for estate planning purposes, just before you die. That's maybe. But I think people get so worried about probate fees, but they're like 1.5%. Like they're way smaller than income tax. Income tax 20 or 30 or 54%. Probate fees are 1.5%. And I see people sometimes just totally mess up their retirement to avoid a little bit of probate fee.
It can be a good strategy just to, if you have a lot of cash in accounts, to start giving some of that money to your kids, because you don't pay tax on it and they don't pay tax on it if it's liquid cash. So you get to at least see how much they can use it or enjoy it while you're still alive.
Yes. So yeah, and in the states they have an estate tax, and if you have a estate tax, you have to always have a gift tax too, because otherwise people just avoid the estate tax, right? So there's a limit to how much money you can give your kids in the States. Okay. Right. But here we don't have a limit from. So this is, a retirement plan can help you with that. So you want to make sure that if you give extra money to your kids, like it's nicer to give it to them while you're alive and you can actually see how it benefits them, rather than they get it after you die. However, you don't want to give it to them and then find out later on, actually need that, and call your kid up and say, oh, can I have that money back? That's, so you need a kind of a plan. Okay, how much money do I need? Even like allowing for things to go wrong. Let's make sure that I have enough for myself. And then if I know I have more, then maybe I'll give some of my kids earlier. But the biggest gift you can give your kids is your own independence. Like I find a lot of our clients are the baby boomers, like 50s and 60s, and they're often worried about looking after their parents later on. If we say, you know what, you never have, the ones that are no, you know what, my parents are good. They have enough money. I never have to worry about them financially. That alone, I think, is a good thing to do. Look after yourself first, and then if you know you have extra, then you can help your kids out somewhat.
Is this trust that you were talking about when you put kids on the house a bear trust? Bearer?
Yes. It's considered a bear trust. Yeah, BARE.
Oh, okay.
Like, so like there's not actually a trust document. Like
Oh.
it's not a legal trust. It's considered a bear trust. But I think right now the government is so searching for money that they're trying to create all kinds. I think those rules are nuts because they think that there's criminals who are hiding money in trust by putting it in trust for somebody else. But for everyone that does that, there's a million people that are, I'm saving up some money for my kids' education, or I'm helping my kids with a mortgage on their house, or I'm putting my kids on my house so that they get it after I die. Like there's so much regular planning that's all caught up on this. And I think 1 out of a million people affected by this will actually be people doing something nefarious with it.
Okay.
Well, somebody asked, does the child have to be a certain age? Yeah, like kids have to be over 18 to have any counts in their name. Other than that, so that's what the younger that you're allowed to give it to them. But whether it's smart and what you're allowed to do are quite different things. No, I think the sixth thing that we talked about, like we talked about the importance of having a higher rate of return, like an equity focus to be able to make a financial plan work. Risk tolerance is a learned skill. Talked about dividend investing being a brain fart. Like, so there's no difference between a dividend and selling a bit of your investment.
Right.
And then we looked at the marginal tax brackets and how they affect, seniors, all the different government clawbacks of government programs and how they change what you do. And so a lot of the tax planning that we do is always around tax brackets. Like what tax brackets are you in? Like, so how much you contribute to your RSP if you're saving up, it's based on your bracket. So if you're in a 40% bracket, I want to get 40% back on all of your contributions. So it's worth putting X amount in and you get 40% on, but not more, because then you only get 30% on that. So then you put it in that amount and you get I'd rather get 40% next year than 30% this year. So, and then when you retire and take money out, it's the same thing. I can take a certain amount out. I think probably for well over half of people, we're trying to take out money at a low tax bracket. But so you can design it so you can take 55,000 is at the low bracket. So you can take 55,000, you and your spouse each. It's 110,000 taxable income. That's basically all the 20% bracket. But you don't want to get more than that, because then you get pushed into a higher bracket. So you can plan which account you take money out of.
Right.
So a lot of the tax planning is around the different tax brackets.
Yeah. And do you also warn people not to take their tax refund from the RSP contribution and just spend it on a new car or something consumption oriented versus trying to make it financially useful for you?
Yeah, because your tax refund isn't free money either. It's a loan, right? Because you put money in RSP, you get a refund, but eventually you're going to take the money back out and you have to pay that tax back, right? So the big plus is if you reinvest the refund as well, that's the real plus.
Okay.
Anne
would like to get copies of your charts. Maybe you can email them to me.
Yeah, actually, you know what? They are all on my blog.
Oh, okay. Perfect.
The child care one is on is a one I did in January called Tax on Parents. What I call this, the clawback of the child care benefit. In the topic 4, marginal tax brackets.
Oh, okay.
At the bottom of it, you have 2 links. One is the RSP gross up strategy, which is cool. And one is about the make your retirement comfortable with the 8-year GIS strategy. So like we found that we can plan around people retire at 65. We can get GIS, like you can set it up so they have no taxable income and they get GIS from age 65 to 72, and then they don't get it anymore. And then, but you can, because after that you're getting your RSP. Like your RSP has to convert to a RIF and your taxable income is too high, so you won't be able to get it. But often people that have a fair amount of money can actually defer all the taxable income.
Paul, you have your hand up?
Yeah, if people talk about redoing their portfolios, on a regular basis, either quarterly or half a year. So I take it with your strategy, there's no point in doing that.
We work through our top portfolio managers. They manage it for us, so we don't have to think about the investments. They're changing throughout the year when things need to make sense. So we don't have to look at it. I think quite a few pick your own stocks, or you're picking ETFs, but not the broad ones, right? Not the MSCI World or the S&P 500. You're picking sector ones, and then you do have to look at these things. You have to look at and decide what you want to do with them, whatever your strategy is for there.
Chris says, does your service include investments, picking investments, I guess? Which I think it doesn't, right? Because as a fee-for-service planner, you're not supposed to be getting into what stocks to buy, but you can talk about how much of your income or your assets you should allocate to stocks.
Yeah, so we're not even investment licensed, so we don't even do investments. However, we understand the asset allocations. Yeah, in a financial plan, you have to put a rate of return in there, and that depends on what asset allocation you pick, right? So that's how far we get with it. But then we think, so for a lot of people, they're trying to get the stock market return. So what we always suggest, like if you're an individual investor, one advice I would give you is have a benchmark that you rate yourself in to see. I mean, how do you know how you're doing? And if the market is, just because the market is down doesn't mean you're doing badly, because maybe you're down less than the market, right? And your investments may be up quite a bit, but maybe you're making a lot less than the index. So like, how are you doing compared to something else? And the easy thing would be you could buy an S&P 500 ETF or an MSCI World ETF or something like a broad index like that, and just put your money in that. And that's a very good portfolio, and that actually outperforms most people, right? So even outperforms most index investors who don't even do that, or robo advisors, and even most of the advisors out there. So that's a good thing. So our portfolio manager, he actually tracks it. We get to see his portfolio. This is what he's done, and here's what the MSCI World Index has done, right? So, and he shows his after all fee. So we get a referral fee from him for our full service clients. So that's how our full service clients get paid, because it's a referral fee from the portfolio manager. But he shows the returns after all fees, including our fee. We expect him to outperform the index over time with that portfolio. So we're using that as a measure of how well we're doing. But basically what we're trying to do is get equity-like returns as a long-term return in some reliable way. And if you pick your investments so you can get that yourself in a reliable way, then good. If not, then pick a broad index, or work with us with a portfolio manager. I think it's important to have a portfolio that you're confident in, that gives you a good rate of return over the long term, and gets all or most of the return of the equity market, assuming you can tolerate that risk level. It just makes your return so much, makes your life so much more comfortable when your investments have a great rate of return long term.
You only have one portfolio manager, or do you have several?
We have two for different strategies. So one of them is using, like, he's an all-star fund manager type. So he's trying to find the world's best fund managers. He has a few of these guys. And the other one is specifically using an index type strategy. He's specifically trying to beat the index. What we found is the all-star guy just tends to be doing better. So almost everybody's with him. But we run into some people that are just index people. They don't believe anything in active management. They only want indexes. So, okay, we got a guy that does indexes, so. And he has a method. So basically he charges his performance fee based on how much he beats the index.
Oh, okay.
Okay. So he has a very low fee, like 0.25, like an ETF, plus 20% of whatever he beats the index by. So, and for index investors, well, if you're buying an index, you don't beat the index. You're going to get the index less a little bit. Right. So they think, oh, that's so good. If I don't mind paying him if I'm beating the index. And not that it's a low fee. So that's, I find for index people, we're there, but the all-star one has just generally been a bit more effective. It's actually a bit more aggressive than the market. So it tends to be up more than the market in up years, and down a bit more in down years. And the fund managers underneath it are all very good, good long-term rates of return. But the overall portfolio is a little more aggressive as well. Since the market goes up most of the time, that's part of how it outperforms.
Okay.
So your index guy, where is he putting the indexes? How is he divvying up the world now?
He does an investment policy statement with each client that's individual. And he might be, looking globally, or might be looking US or something. He often has a little bit of a piece in Canada. Like he often has more in Canada than I would put in Canada, but he'll often have 20 or 30% in Canada, but quite a lot of it is global. We've been trying to encouraging him to have, use something global, but he always compares to the same index. So if he has a global portfolio, then he'll compare it to the MSCI World Index, and so he doesn't buy the index. He tries to buy the one or two or three best stocks in each sector. So he tries to have the same sector allocation as the index, but just have the couple best stocks. He's trying to get, most of the time pretty close to the index, but when he beats it, then he charges his extra performance fee.
And he's in emerging markets as well, right?
He does have an emerging markets portfolio. Yes. It's usually it's only certain people get it in a small part. Like you can request it with him, but yeah, it goes more. Emerging markets would only be a small part for pretty well everybody.
And all equities. Both your managers are all equities and no bonds.
No, both of them will do all equities, but they assess each client. Each client on their own, and they'll do whatever it makes sense for each client. They do their own risk tolerance for each client and figure out what's appropriate. But I mean, a lot of people come to us for an equity portfolio or for a leverage portfolio, and so then the portfolios managers already kind of know. And they find that our clients tend to be like, a lot of them are the younger, more knowledgeable, more aggressive kind of people. But what I found when I actually went around and studied met a lot of these independent portfolio managers, and I found a lot of them wouldn't do 100% equities no matter what, no matter how aggressive the person is, they wouldn't do it. I had a guy that called me up. He's an engineer. He was 28, knowledgeable about the stock market, really aggressive and young. He's high income, and he wants to make a higher rate of return. So he went to a robo-advisor thinking he's just going to get an index portfolio. And so what he did is he gamed the portfolio, the risk tolerance questionnaire, and answered every single question with the single most risky option. And came back and said, you have to be 20% bonds. He says, why do I have to be 20% bonds? I don't want bonds. I understand the stock market. I want growth, right? So we actually called in, talked to the portfolio. This is one of the big robo-advisor companies, and said, I know what I'm doing. I'm high risk. I don't want to buy bonds. Just do an equity portfolio for me. And the most that guy could do is 10% bonds. So I said, we can't, there's never can we have less than 10% bonds. Really? It's like, there are people where 100% equities is the most suitable thing. So both of our portfolio managers will do 100% if that's what, makes sense for you.
Can people communicate with you through your blog, or do you want to give an email address?
Well, the easiest is through my blog. So in fact, a simple one is if you go Rempel. So we offer a free 30-minute consultation for people that are interested in, you potentially want to be, become clients. We have a free 30-minute consultation. We just say, well, like, what are you looking for? And we'll talk about our process and see what makes sense. edrempel.com/talk. And you get to it. Or if you just go to our blog, hit the contact one, you'll see free 30-minute consultation.
You have an office?
Yes. Our main office is in Brampton.
Oh, okay.
We have a condo downtown Toronto that we occasionally meet people with. But actually, you know what? Since COVID, we do almost everything Zoom now. We get clients all across Canada. Of course, most of them aren't going to come here anyway. But even people that are local, we haven't gone to a client's home for 20 years. They always would come to our office, right? But now, even the ones that are 5 minutes away, well, it's easier to be on Zoom. I'm at home. And, I used to think it was not personal, and our business is very personal. In fact, we set up our office so that the main client meeting room, it's not a boardroom. It's a living room with sofas and chairs right. And we have a big screen TV so that while we're working, people can see what we're working on. And we made it very homey on purpose because it's a very personal service, like investments is a sales game. We're a very personal financial planning advice thing. So that's what we wanted to have. But I found with Zoom, you're actually closer to people's face than you would be if you were in person. And you can see their expression. And we've kind of gotten used to that, it actually can be very personal. And it's easier for us to be working on some things and then show people things on a screen. It's easier to see it all than on Zoom. So yeah, we do have an office. We can come to our office, but almost everybody actually prefers Zoom.
Right. And you're kind of a psychologist too, because you're trying to figure out, how the spouses get along and what they think about leaving money to their kids and that kind of stuff.
Yes, that's why we really insist on having, the financial planning meeting that both spouses there. I want to see how they react. And, sometimes you get one spouse is aggressive investor, one's conservative, and yet they have joint investments. Okay, so how are we going to handle this? This is a discussion, right? And usually one of them would just dominate the other, but it's like, okay, look, we're doing a plan here. You both have to be happy with this, and it has to work for your plans, right? So let's talk. Yeah, there is quite a bit of psychology involved. Actually, my wife years ago was the top instructor in Ontario for the Dale Carnegie course.
Oh.
She was like a personal coach, and she's very much about, helping people, reading people and helping them build confidence. And so she's been a huge contributor over the years.
Okay, well, thank you so much for giving us all this time, Ed, and it was very helpful, useful, and I'm sure if you have questions, you can write to Ed and get some.
Yes.
back.
I hope you found it interesting. Unconventional wisdom,
Yeah.
but it's maybe different from what you hear from pretty well everywhere. But remember years ago they had, what is it, Monty Python's Flying Circus, and they kept saying, and now for something completely different. And sometimes that's how I feel people think about me. But I think I just do plans, and this is what from my experience, this is what works. So
Peter Hodson at 5i Research.
5i, yes.
Yeah, philosophy similar to yours. He thinks that people are way too consumed with what if the stock market goes down, and they forget how it quickly it comes back, it bounces back, and they're just too nervous sometimes and take too little risk for the results that they hope to achieve.
That's it exactly. Yeah, and I just see that because then I try to do a financial plan with a 5% rate of return, and you can't get there. And now what are you going to do? You're going to work for 5 or 10 more years, like is that what you want to do? And because surprisingly often you could, generally over 30 years, you actually have to save like twice as much to have the same retirement with a balanced portfolio versus an equity portfolio. Would you rather invest 40,000 a year to have the retirement that you want, or in a balanced fund, or you learn to have a bit higher risk tolerance, and now you can invest 15,000 a year and in an equity fund, and then over 30 years you still have the same retirement.
Right?
So it's a super highly learning to have a risk tolerance is a super valuable skill.
Good. Well, thanks so much. And
Actually, one other thing: if you end up with questions, you can just go to my blog, find a topic or YouTube or podcast. Find actually just do the blog or podcast. I don't really answer questions.
You've got a search box.
But you can go to one of the talks, find a blog on the topic, and just ask a question. And I can just I don't usually, if people just call me up out of the blue, I don't just ask questions for people and clients. So, but if you ask it on the blog, then other people can learn from them as well.
Right.
I'm usually a month or two. I'm a while behind answering questions, but I will always get to them.
Okay. Thanks very much. And it was a pleasure listening to you.